Hello, and welcome to Portfolio Matters. Weekly markets update, week 162. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Well, we have a packed week as we missed last week as I was away on holiday. So we've got a lot of macro data to catch up on. So we'll be concentrating on that this week, and this much delayed discussion of the gold standard will have to wait yet again. Reminder, it's pub night on Monday, and we will be on the Thames at the old Thameside Inn, Pickford's Wharf, SE1. Hope to see a few of you there. Richard and I will both be there.
Definitely looking forward to it.
Okay, lots of news over the last couple of weeks. So the Fed met, they kept rates unchanged, and in a series of what appeared to be quite coordinated bullish speeches, the Fed governors all gave hawkish pronouncements about the future path of interest rates and signaled only one rate cut this year. They also raised their inflation forecast for the current year. The Bank of England met, they kept rates unchanged, but they were surprisingly dovish, actually, saying that the decision to keep rates unchanged was finely balanced, and they left open the possibility of cutting rates in August when they next meet. The Swiss National Bank cut for the second time.
So the Swiss National Bank now has, Switzerland now has negative interest rates again.
Really?
Yeah. Inflation of 1.5, interest
Oh,
rate 1.25.
okay, real, yeah.
Yeah,
Real.
sorry,
Yeah,
negative real rates.
yeah, yeah. That doesn't surprise me, actually, because they can't let the Swiss franc strengthen too much.
No.
Now, the big kind of macro news for the last couple of weeks was the extraordinary political turmoil in France. So, in the European elections, President Macron's ruling party got trounced by both the right and the left, and he's called parliamentary elections. Now, we have a special section on that coming up, but so far his gamble does not appear to be working. Nvidia just surged, continued to surge in an astonishing way. Shares are now up 40% in the past month, and it is the most valuable company in the world. US inflation came in soft. 2 weeks ago, non-farm payrolls came in hot. We have a section on that. And UK inflation returned to the 2% target. It's expected to bounce from that, though, as service inflation remains high. Some charts relating to the news. Well, this is the Fed's forecasts, and you'll see they have raised their forecast for inflation for 2024 from 2.6%, their forecast in March, to 2.8% now. And they've also raised their forecast for where the Fed funds rate will end the year. And the big story of the year has been the rise in interest rate expectations. So this is the expected path of US interest rates. The blue line is at the start of the year. The yellow line is now. And this is the Fed's predicted path for interest rates. And the one thing you know is this is going to be dead wrong, as we've
It
covered
looks
many
it looks
times.
unfortunately like a case of brewer's droop, Keith.
Yes. And this is the interest rates for all the major central banks. You see the Swiss National Bank has cut twice, the ECB's cut once, the Fed and the Bank of England not at all, but rate cuts should be coming. So if we look around the world, more banks are cutting rates than have raising rates, but the move into from hiking to cutting has been slow and cautious. Now, Nvidia, this is its share price performance over the last 10 years, 20 years. It's just absolutely astonishing. Shares are up 40% in the past month, making it the most valuable company in the world. And when you compare its market cap to the entire stock markets of the UK, France, and Germany, it is much more valuable. Amazing. I mean, I've been calling the top in this so many times
Mm.
and have just been absolutely dead wrong. And actually, shout out to our Discord member, Simon, who has played this incredibly well. And actually, watching the way he's played it has been really educational in that, you know, I like to try and predict what the value of something is, and he's entirely neutral on value. It's just says the market determines value, and he plays the trend, and he has been absolutely right. That's been the way to play this. Now, this is France and the opinion polls. Le Republique En Marche, which is the yellow line, is President Macron's party, and his gamble of calling a snap election does not look like it's working. RN is the far right alliance. NFP is the far left alliance. As the things stand, it looks like the far right are going to win the most seats in Parliament.
Mm.
And this is data out this morning. This is the service PMIs from France, and they unexpectedly fell in May. So political turmoil is leading to economic uncertainty. Moving to Britain, well, Conservatives are not doing well. Labour are forecast to get the highest parliamentary majority since 1924, and the Tories are forecast to get the lowest number of seats they've had since the formation of the party in the 1830s. Very bad, actually. Country is best governed when the majority is quite small.
And there's a
As this
balance. Yeah.
Yeah, as this stands, the real opposition will be the left wing of the Labour Party. And finally, we've talked about previously how the temperature anomaly in the North Atlantic is at a record, which means there's a lot of energy building up in the Atlantic. Well, the storm season has begun, and we've had the first named hurricane, which was Alberto. More are coming. Watch this space. Okay, and on to this week's economic data. A quick summary. Well, the latest UK data actually appeared to clarify some of the uncertainty around the UK economy. We will take you through it, but it appears the UK economy is pretty stagnant. The EU is weak, but showing clear signs of strengthening. The US remains strong, but more signs that the rate of growth is slowing. China, difficult to tell. On to the UK, Richard.
Thank you, Keith. The UK retail sales month on month. May was a good month, and that's actually looking quite positive, really. The figures were revised, Maple's figures were revised as an improvement, and May was better than expected.
Yeah. But if you sum over the last 4 months, that's still not great.
Yeah. I mean, anecdotally, the business that I work for is seeing quite a slowdown in discretionary expenditure. The UK CPI is looking very, very good, isn't it? It's still up and then back down to 2.
Yeah.
Obviously, the problem here is the US services, it's the UK services inflation
Yeah.
rate. And this is a monthly core CPI, which is 0.5% in May, which actually annualized is quite high.
Mm.
And I think the other point is we have energy prices, I believe, are falling out of the inflation data. The reduction in energy prices is going to fall out of the inflation data over the next few months.
Yeah, we're expecting CPI to have another leg lower in July when the new price cap comes in.
Yeah.
But goods inflation has been a big negative influence on CPI of last year, and that is the fall in goods inflation is expected to basically stop.
So I noticed I we went out with a meal with four of us, some friends, the other day, and the bill was £257 for a meal that I would have anticipated a couple of years ago would have been in the 120, 140 bracket.
Yeah.
And I think that's an indicator that we really have had quite a massive level of inflation that is hitting people because salaries haven't gone up, anything like that, wages haven't gone up. So
Yeah.
I do think that in some senses, this 2% core CPI is understating the issue.
Well, the thing is, Richard, and we will get onto this in a second, but services inflation, in particular restaurants and hotels, that's been possibly the worst component.
So UK RPI year on year, 3.0%, slightly lower than expectations and down from April.
Yeah, that's good.
Yeah. And the good news, competitively, is that our inflation rate is now lower than its European neighbours, having, it must be said, been significantly higher than most of our European neighbours
Yeah.
for quite some time. It's interesting, actually. The exchange rate of pound against the euro is quite strong, relatively speaking, over the last few months.
Yeah, I mean, that's basically it. UK interest rates are much higher.
Yeah, and the ECB cut, didn't it? And
Yeah.
we haven't. So CPI goods services core inflation rates is high.
Yeah.
The
This is
services
exactly what
inflation.
you're talking about, Richard.
Yeah, and that is very very bad for the economy, especially since the UK is highly service based.
Yeah.
And as Keith said, this is a price of pub meals risen sharply since the pandemic, and that's a 30%, roughly 30% rise, 25 to 30% rise, isn't it? I
Yeah.
would have said they've gone up more than that personally, but it's a big rise.
Yeah. No, I too have noticed that how restaurant meals in London are just incredibly poor value. It's much better to invite people round now so you can drink your own wine.
And this is a price for staying in a hotel, and there is, as the says aside, a lot of strong seasonality, quite a choppy
Mm.
chart, but basically 120 versus, let's say, 80 in January 21. That's a 50% rise.
Yeah.
And price of restaurants and hotels, large contributors to the UK inflation rate.
Yeah.
And that's is it grey? Is that grey?
Yeah, it's the grey bit.
Getting more significant actually as inflation drops. It's not dropping. That particular rating is not dropping very much.
Yeah, but reminder, I mean, a lot of inflation happens between the months of February and May in the UK. So
Yeah.
hopefully the
Yeah.
price rises should ameliorate from here.
So food and non-alcoholic beverage prices fell in May, up 1.7% year on year. And furniture and household goods annual inflation rates are very low. In fact, they're negative. So if you're setting up a house, that's now good news.
Yeah. So services inflation persistent, but goods, food, drinks inflation negative, and that's kind of offsetting it. So that's how we've got to 2%.
Good news if you're setting up home, particularly. Annual motor fuel inflation is become positive,
Yeah.
having fallen significantly.
And spoiler alert, oil prices are up again in June.
Yeah, and UK PPI input year on year fell very slightly in May, but very significantly less than was expected.
Yeah. But that's still good news. Input prices
And then,
falling.
yeah, it is good news, and it's remains to be seen whether that line goes above zero. But it's
Hmm.
UK PPI output prices year on year, 1.7%, and consensus of 1.9. But nevertheless, there is a little bit of an upward shape to that
Yeah.
recent data line.
But nothing to worry about.
Yeah, UK GDP month on month, effectively, we didn't grow in April, um, and
Yeah.
The UK economy is, I would say, it is not it's not happy, it's staggering. And if it grows 1 month, it's not by very much. We're not in a great place
Yeah.
at the
So
moment.
Rishi Sunak, having called an election, I think he called it at the peak of UK economic growth last month. So the National Institute of Economic and Social Research are forecasting GDP growth of 0.1% in
Mm,
May. So not great.
yeah, not at all. UK GDP year on year, well, they are, it's basically we haven't grown, have we, to any significant extent.
Mm.
Um, and it's pretty sad looking graph up. Service sector is continuing to grow, but there was an offset of falling manufacturing and construction,
Yeah.
interestingly. And UK industrial production actually down 0.9% in April, which is not great at all. And there's a lot more, if you look along, there's a lot more of the light coloured bars than the dark blue bars, aren't there?
Yeah. Because the PMIs again, the PMIs seem to show that UK industrial production was bottoming, but that's not a good number.
No, no, it's not. Um, and UK industrial production year on year is down 0.4% year on year in April. I mean, my conclusion about Sunak calling the general election was apart from the fact he wanted people to make a bit of money out of placing a bet on it, was was that he thought that economic indicators, economic data was going to get worse if he left it until the autumn.
Yeah.
Now, whether he had some sort of insight that we're not getting, anyway. UK manufacturing production month on month down 1.4% in April.
That's a
Not
bad
good.
number.
Yeah. And year on year in April up 0.4%, as opposed to consensus of 1.6%, which, relatively speaking, is a big miss. UK construction output does seem to have gone negative, doesn't it? 2 months of negative data now. Uh,
Yeah, but the PMIs have turned positive. So, construction industry is feeling more positive about the world, but output is actually falling.
yeah. So UK earnings, including bonuses, 3 months year on year, up 6%, and this is what we are seeing. This is why I don't think inflation is beaten
Mm.
by any means. But I also think that these 6% year on year, when we've had, if you look at um, if you say prices have gone up between 25 and 30%, means you need to have those pay rises for 4 years before you start to catch up to where you were.
Yeah.
In reality, I think that's the truth for a lot of people. Um, so I don't think we're out of the inflation hole yet by any means. And this is UK earnings, including bonus month on month, so up 0.4% in April. So one other point about the UK economic data is, we have still got people coming off, significant numbers of people coming off fixed rate mortgages and
Yeah.
going back on a new fixed rate mortgage at a much, much higher rate, which is leaching money out of consumer discretionary expenditure.
Yeah. Agreed.
UK earnings 3 months, the year on year, excluding bonuses, 6% in April,
Yeah.
6% in March.
Just not
Consensus,
coming down.
6%. No. And excluding bonuses, month on month is 0.5%. So very similar figure. So the NIESR is forecast a sharp drop in UK earnings growth in half two.
Mm.
Yeah, I mean, maybe so. And obviously, that would help to bring inflation under control. Personally, I'm not convinced. Did you see in the FT this morning that IG Metall has put in the unions put in a 7% pay claim in Germany?
Yeah, that seems frankly delusional to me, given how badly the German industry is doing. But
Yeah,
they can try. Now, the thing about this chart, Richard, is the red line is public sector. The black line is private sector.
yeah,
So what they're saying is that public sector pay is going to revert to 2% in is that June, July, August,
yeah,
and that will bring down overall pay to 4 and a bit percent. Notice their forecast for private sector pay is decaying only slowly.
very slowly. I mean, that sort of, yeah. Well, I mean, I think the new Labour government, which we're almost certain to get, is going to come under a lot of public sector pressure for pay rises.
Mm,
And indeed, it's going to have to solve some fairly significant issues, like what's it going to do about the junior doctors' pay?
yeah, I agree.
Because the NHS can't be fixed until the appalling relationships the government's got with the junior doctors, many of whom are in their late 30s, by the way.
Yeah, I know. The junior doctors is quite a it's a
Yeah,
misnomer, basically.
it is. And their treatment has been utterly appalling by this government.
Yeah.
So public sector pay grew slightly faster than private sector pay in the year to April, which is interesting.
Mm,
Construction sector pay is the bottom outlier there, isn't it?
yeah,
It's
that's right.
presumably an indication that there's a slowdown in the construction sector.
Yeah, which we've seen.
Yeah,
But you see that hotel and restaurant wages are coming down.
yeah.
So that should hopefully,
Well, the rate of
service
increase is
sector.
dropping, actually, to be technically correct.
Yes, that's true. Yes.
Britain is enjoying a respite from strikes. I know it's quite nice, isn't it? Train drivers' strikes seem to have disappeared. The
Yeah.
post office workers, I don't know what they've done to sort that out. Maybe they told them they'd all lose their jobs because they would if they. Um, and obviously, we've still got the junior doctors ongoing. And UK 3 month employment. So there's been a reduction in employment over all this year, actually.
Yeah. Now, every month we've done this previously, I've been puzzling on how these numbers could seem just way too high. And actually, it's because although the headline says employment change, it's the 3 month employment change. So this month we've got the labeling right. But that's still quite a big number. There are 33 million people employed in the UK. So losing 140,000 jobs over the last 3 months, that's quite a lot. That's about
Mm.
0.3%.
Mm.
And, in the period to March, that's about 0.5%.
Well, it's tricky, isn't it, Keith? There was a period towards the end of last year, which may well have been sort of running up to Christmas, where employment goes up. Now we've got a period where it's going down. We don't think the economy is growing, so you'd expect employment to be roughly steady.
Mm,
So it's until this number gets bigger one way or the other, it's difficult to know if there's anything particularly going on under the surface. Higher interest rates. So this is the level of economic activity and actual, if the pre-crisis dotted line trend had continued pre-pandemic. So,
mm.
I mean, basically, the UK has virtually stopped growing, hasn't it, since the pandemic?
Yeah. So this is the number of people employed.
And the UK unemployment rate is low,
It is. Yeah, it's ticking up,
4.4%.
but it's low.
Yeah. And this is a divergence between the unemployment rate for men and women. So men are more likely to be unemployed than women, with people in the middle.
Yeah. I found this quite odd, actually. Because that's quite, the trends are quite different.
They are. I mean, male unemployment is going up, female
Yeah.
unemployment is falling.
Yeah. If anyone can interpret that, please get in touch.
Yeah. And people, presumably, is just in the middle. Uh,
Mm.
UK employment rates, people, men and women, what? Seasonally adjusted. I mean, this is quite a flat.
Yeah. But I mean, what's noticeable is employment rates for men have fallen a
Yeah.
lot more than for women. Do you think
Yeah.
that's the construction sector?
Well, it could be, couldn't it? It's definitely
Yeah.
or engineering, heavy manufacturing. It's something.
Yeah.
Yeah.
Mm.
UK claimant count month for month. Well, that is a big jump, isn't it?
Yeah. The trouble is the UK statistics are so bad
Yeah.
that, let's see what the revised number is next month.
Yes. Good point, Keith.
But to be fair, they didn't revise the April number.
Mm.
So Perhaps that is true.
UK HMRC payroll count, they revised the April number hugely. I
Yeah,
mean, this data is just comes into their computer and gets spat back out. One would have thought. I don't really understand the trickiness
yeah,
with real time reporting. Anyway, that for what it's worth, that's their data.
yeah. It will be revised next month with 100% certainty.
Yes. UK trade balance month on month, not good at all.
Yeah, bad.
Look at that. Consensus expectations 1.2 billion, actual 6.7 billion for the deficit.
Yeah, that's a big number.
What are we importing, Keith? I suppose fuel.
Everything. What do we make, Richard? Put it the other way around.
Yeah. Um, the house price balance down 17% in April. That's a big drop, isn't it? So that's more prices down than up, isn't it?
Yeah. Which is, makes sense, frankly. I mean, it just mystifies me how
Yeah.
anyone can buy a house at these prices and these interest rates.
Noisy chart though, isn't it?
It is.
You need a
Yeah.
bit more, a few more data points to see where it's going.
Yeah, but when the trends turn, they do tend to turn,
Yeah.
down. But as you say, 1 month is nothing.
UK consumer confidence is rising. I mean, in order to get back to neutral, it needs to be, I would say, between -12 and 0, doesn't it?
Yeah, actually, this is surprising
Yeah.
given the rise in unemployment.
Yeah. So it's not far off recovering from whatever knocked it for six in 2022. I guess it was
Yeah,
the price rises in natural gas and Russia-Ukraine, Ukrainian adventure.
yeah,
So the UK PSBR, excluding banks, well, on consensus, but that PSBR is big, monthly, large, and is not in any sense being addressed, is it?
yeah. But the good news is it was better than expected, and they did revise April down. So,
Yes.
it's still bad.
Yeah. Deficit is 4.25% of GDP. And it really doesn't give any incoming government much scope for maneuver, does it?
No, it doesn't. No, he's going to have to raise taxes. I mean, frankly, I think the last two Tory tax cuts were just totally irresponsible.
I think the problem is if he raises taxes, it puts more burden on the economy and trying to get the economy out of its hole. And it's a bit like, I mean, unfortunately, that in my view, one of the best ways of getting the economy going would be to reduce taxes. But the scope to do that in terms of the demand of public services and I have to say the gross mismanagement of public services over the
Yeah.
last 40 years by the Tories makes that virtually impossible. And it's like trying to pull ourselves up by our bootstraps. Anyway, you heard it here first. We're all depressed. However, the economic surprise index is looking surprisingly good.
It is.
Okay, so this is the perennially downward sloping chart of the week. Wage growth 6.5%, which is in tune with what we've just seen a little bit earlier.
Yeah. I mean, the thing is, Indeed is not job postings. We know that the minimum wage is risen by 9.8% in April. So it's not really surprising that you're seeing this rise in
Yeah.
6.5% year on year in posted salaries. But it depends on what the job mix is.
Did you see? And my mind is just tracking also. So obviously, we're talking about as the minimum wage goes up, at what point does it squeeze low-paid workers out? And something like AI comes in and takes their place, e.g.,
Yeah.
with McDonald's service stuff. Did you see the video that went viral of people trying to engage with an AI McDonald's service in the US?
No.
It was, I mean, it was incredible. You know how you get when you get into those telephone menus
Yeah.
and you end up saying, I just want to effing well speak to someone because it was like that. You know, it was it was dreadful.
Right.
Anyway, so that's simply a question of I'm not quite sure at what point in reality these people's jobs will be squeezed out if they require if they're a service as opposed to a sort of mechanical function. UK trueflation is low, 2.8%. Yeah, it's good.
Heading in the right direction.
Yeah,
And the thing is, trueflation is not seasonally adjusted. So
yeah,
you'd hope that in the second half it comes right down. But as you say, wage inflation being what it is, you need to get wage inflation down to get trueflation down sustainably,
yeah.
unless the Chinese keep on pumping out cheaper and cheaper goods, which, so far they are doing.
Uh, Percent of UK mortgage balances in arrears. Now, I would say that whilst that isn't a cause for concern yet, if it carried on that trajectory for another 6 months, it would be. What do you think, Keith?
That's actually, I'm surprised by how high this is, because like 1.5%, that's a big number, of the people. So about 40% of households in the UK have mortgages.
Yeah,
And, you know, 1%, that's a lot of unhappy families, actually.
yeah.
And that keeps on rising. Now, hopefully, it shouldn't really, because, we're getting to the point, if the Bank of England starts cutting rates in August, you'd hope we're getting towards peak mortgage stress.
So if you have a read through the summary, and bottom line really is that inflation is coming down slowly, although service inflation is worryingly high and wage inflation is still high. The economy appears to be stagnant and unemployment is probably rising. So not a good look for the UK, I would say, Keith, at the moment.
Yeah, and you'll notice that KPMG came out this morning saying they're cutting another
Yeah,
200 jobs.
I do.
Um, I think the AI, you can certainly see AI having an effect on the service sector in the UK, leading to, job losses in like highly paid service sector jobs.
Mm. There's an article in the FT this morning about a paper that's been written about which jobs are most susceptible to AI loss, and it is service sector jobs. But if you get a chance to have a look at it, it's quite interesting.
Yeah. Okay, on to the EU. Thank you, Richard. So wage growth Q1, 5.1% above expectations, and actually up on Q4. So the ECB has cut rates, but the market is concerned that it won't be cutting them very quickly from here. Industrial production in April, not good. Like the UK, down. Well below expectations year on year. That is a pretty terrible number, down 3%, well below expectations, down on March. Construction activity, not good. Downgraded. The March number was heavily downgraded. The April number was minus 1.1% year on year. It had been expected to rise 1.1%. So the construction sector in the EU not doing well. But the good news is economic sentiment has picked up to 51.3. This is economists. They're feeling more positive.
Is that
They've been
because they're feeling
feeling,
positive about their projections?
well, not with good reason, I'd say, given, the April numbers. The well, good news for the EU is the
Hmm.
current account balance. They are paying their way in the world,
Aren't they? Yeah.
unlike the UK. Citigroup Economic Surprise Index fading a bit, still positive. Now, we had indeed job postings numbers. So in Germany, they actually ticked up a bit. I think you'd still say downward slope. France, definite downward slope, frankly. So in summary, in the EU, not much new data, but the bottom line is the EU economy is weak. Economists and consumers are feeling better about future prospects, but there's little evidence of an upturn yet. Now, we have a special section coming up on France, and France could yet add to turmoil in the Eurozone, depending on the outcome of the election. Reminder, the right-wing parties in France have previously campaigned on Frexit, i.e. France leaving the euro and the eurozone, that would be catastrophic. On to the US, Richard.
Yeah, thank you, Keith. US non-farm payrolls looking jolly good, actually.
Yeah, I don't believe this actually.
No, I mean, there's questions. A lot of people say the data is manipulated because it helps Biden get re-elected. I have no view on this, but I know a lot of people are very skeptical about the data generally.
Okay, we're going to do very few special sections this week because we've got a packed program full of macro data, but we do have something coming up on non-farm payrolls. Basically, I think the birth and death model's wrong. I think it's exaggerating
Yeah,
the number of jobs being created by new businesses.
interesting to see that. So jobs growth broad-based, particularly in healthcare and government. I mean, government.
Yeah, this is likely
And
to change.
yeah, and there's that rising construction jobs, whereas we believe construction in the US is slowing down.
Yeah, that mystifies me. I'm just mystified by that. We will show you later um, that building permits and housing starts are falling quite sharply, actually.
Yeah,
How does
sharpest
that
on
work?
yeah, sharpest since the pandemic, I think, isn't it? Government jobs grind relentlessly higher, it says here, which is absolutely true. I mean, look at that. And that's that's
Yeah.
23 and a half, nearly 23 and a half million government employees in the US.
Mm,
No wonder they got such a big deficit, eh? Um, so all the new jobs have been part-time with full-time employment falling. But a part-time job is counted as a whole job, isn't it, in this
yeah.
data?
Well, if the non-farm payrolls counts all jobs. So if you hold multiple jobs,
Yeah,
those
you
are
hold
counted twice.
yeah. Full-time jobs peaked in June last year and are slowly declining actually. And
Yeah.
part-time jobs, as you can see, are still rising.
But again, this is, the difference between the household survey and the non-farm payrolls establishment
Yeah.
survey.
Yeah. The household survey is reporting a loss of 408,000 jobs in May.
Yeah.
Well, which one is right?
Well, I know which one I think is right, but
The
the
household, I mean,
market thought the non-farm payrolls was right. So, they're the ones that matter.
the non-farm payrolls is a suspiciously smooth line, isn't it? So have a look at this table because there's a lot of data on it. But basically, the household survey reports rising unemployment and a falling number of jobs.
Yes.
So,
Whereas the non-farm payroll reports exactly the opposite.
yeah. So according to the labour force survey, the economy lost 625,000 full-time jobs last month and added 286,000 part-time jobs, which is really, really different to the non-farm
Yeah.
payroll.
So the
Really
detail of the labour force survey is even worse than the headline. So
yeah,
it lost 408,000 jobs, but actually it lost 625,000 full-time jobs.
yeah, which is a lot.
Yeah.
uh, and all of the jobs growth in the last 4 years has gone to foreign-born US workers. Now, so we're reading a book at the moment about migration, and it's quite a detailed analytical book by a Dutch academic called Heine de Haas. I think that's his name. And so, if you're interested in this and how this works and what the benefits and the disbenefits are for economies, then I think it's a good book to read.
Well, actually, I thought it was an excellent book. And next week, should we have a little discussion on it, actually?
Yeah, sounds like
Because it convinced me that almost everything I thought I knew about migration was wrong.
so the huge surge in US immigration the last few years has eased labour market conditions and probably brought down inflation.
Yeah. So the last 2 years, seen a big surge in immigration, and this is to April, so it's continuing.
So here we have apprehensions at the US border, suggesting illegal immigration continues to record rate. One of the interesting things that this book says is apprehensions is quite a dodgy statistic because
Mm.
people will make multiple attempts.
Yeah,
So you might have 10 apprehensions for one person. I made that up as an example.
yeah, that's true. But based on encounters,
Yeah.
This would seem to be right. You're on for another 4 million.
This is the US unemployment rate, which is 4%, basically, steady at about 4%.
Yeah, ticking up, but still very low.
Yeah. And the US U6 unemployment rate, steady at 7.4%. And again, it's ticked up a little bit from last year, but it's
Yeah. Reminder
basically.
that includes discouraged workers.
And the unemployed number, the number of unemployed people is actually its highest level since 2021. And it's gone up, hasn't it, it's gone up by 750,000 in the last year and a half.
Yeah.
But then there's been a lot of migrants coming into the US, so
Yes.
we could put that into the mix. US average weekly earnings month on month, May 0.4%, which equates to about 6% year on year.
Mm.
And US average weekly earnings year on year, 4.1%.
Yeah.
And it's
April
slowly
revised
declining.
up.
Yeah.
Wage growth persistent.
Yeah. US participation rate seems to have stabilized at around about 62.5%, doesn't it, Keith?
Mm.
Having risen from the pandemic.
Yeah.
It's actually slightly lower level than pre-pandemic. US average weekly hours, same as expectations, same as last month. US CPI month on month, 0% in May.
That was a good number.
Yeah.
Good number.
So US CPI year on year, 3.3%, which is very similar to April, very similar to expectations. And core CPI month on month is 0.2%, which is considerably better than expectations and down from April. Core CPI year on year, 3.4%, similar to April and similar to expectations.
Yeah.
So it
Actually,
does. US inflation does seem to be stabilizing, doesn't it?
yeah, absolutely.
And stubbornly higher OER is
Owner's
keeping,
equivalent rent.
yeah. So measure of of accommodation costs, is keeping US inflation high, which we
Yeah.
commented on before.
Yeah, it's lags. We've talked about this many times, lags by
Yeah.
between 12 and 18 months. So,
And US core CPI ex shelter is below 2% on a 3 monthly annualized basis. And the harmonized CPI measure is now below 2%.
yeah.
So,
So,
so that's okay.
so basically, if the US measured inflation the way the Europeans do, we do, then inflation would be at the 2% target and doing nout. So it's staying high because of all the silly stuff they put in, like owner's equivalent rent.
So services inflation, as in the UK, is remaining elevated at 5.25%.
Yeah, but
And
that
this,
includes shelter and car insurance, etc.
yeah, the low May print was basically a consequence of falling food and energy prices. Now, I think energy prices are possibly going to turn around, aren't they?
They are.
Coming into
They've
the US
had,
driving season and so forth.
well, we've had a big bounce in oil prices last few weeks.
Yeah. And as Keith just said, so services, basically, most of services is shelter. And you can see that shelter and transport are pretty much offset. Um,
Yeah,
so shelter and energy pretty much offset each other.
yeah. But so this is actually encouraging, because
Yeah.
other is minimal.
Yeah. And Goldman expects US inflation to gradually subside towards the 2% target over the course of the next 12 months.
Mm. I should say that other forecasters are forecasting it to bounce, but they didn't have a chart.
Yeah. Yeah. US PPI month on month, minus 0.2%. And PPI year on year up 2.2%.
So factory gate inflation actually close to the 2% target.
Yeah. And core PPI month on month unchanged in May, so no inflation in May. And year on year 2.2%.
Yeah.
You can see why people think we're getting increasingly closer to interest rate cuts, can't we, in the US? US
Yeah.
credit change was It was increased to 6.4 billion in April, but the expectation was for 11 billion,
Yeah, and if you look at this over the course of the last 5 years, that is quite a low print.
isn't it? And last month was a low print as well.
Yeah.
And so after inflation, the actual real change in consumer credit was negative. US retail sales month on month, very slightly up.
But disappointing.
Yeah.
And the April number was revised down.
Yeah. US retail sales year on year, 2.3%, with April revised down to 2.7. So it's okay, isn't it?
Mm.
US industrial production month on month was up 0.9%, which is quite a big rise.
Yep.
Year on year is up 0.4%. So I think there is growth. If you look at that
Yeah.
line, there is
Not
some growth.
huge growth.
No. US manufacturing production month on month was 0.9% up from a drop in April and much better than expectations.
Mm.
And manufacturing production year on year only 0.1%.
Yep.
And the NFIB, National Federation of it's actually small businesses, isn't it?
It is.
Independent businesses. Um, was business optimism 90.5%, actually basically very similar to April and expectations, and not at a particularly high reading.
No, that's a bad number, actually. When you look at the long-term
Yeah.
chart, that is bad.
US government budget month on month was much worse than expectations at 347 billion.
Yeah, that's a bad number. Geez, that is, 50% worse than expected.
Yeah.
Geez.
Michigan consumer sentiment, a chunky drop actually since a couple of months ago.
Yeah. Yeah, it is, it does bounce around,
Doesn't it? Yeah,
but
it's bouncing around increasingly more.
yeah.
US Michigan current conditions, big drop actually over the last few months. Consensus 71, actual 62.
Yeah.
US Michigan consumer expectations is on a sort of noisy uptrend, isn't it? And it's in the down part of its uptrend at the moment. 1 year inflation expectations have dropped right back down and are just above 3.3% now, 3.3%. 5 year inflation expectations, 3.1%.
Yeah, not coming down.
No,
Coming
they're sort of
down.
stuck at that level now, haven't they?
Yeah, that will concern the Fed.
Yeah. And consumer sentiment, which appears to be dropping again, is pretty low level. It's at the lowest level it's been apart from 2022.
Mm.
Lowest level it's been since 1979, 1980.
Yeah, so this is for buying large durable goods.
Yeah.
And unsurprising when you've got, for rising unemployment and very high interest rates,
Yeah.
you know,
Real household income expectations are pretty pessimistic.
yeah, this is quite a, I mean, this is noisy. All these surveys are noisy, but
Yeah, but
that's
that's a
quite a big drop, isn't it? Very
big,
quickly.
yeah. They're picking something up, aren't they? So US National Association of House Builders House Market Index is a little bit lower than expectations and lower than June. It's bouncing quite noisily between 33 and
Mm.
50.
Yeah, I mean, the thing is, housing starts have fallen, construction activity's fallen, but construction employment has continued rising over the last couple of years. I mean, how does that work?
Yeah. US building permits, a steep, sharp drop. It
Is it
was,
finally, are higher interest rates finally starting to have a real
yeah,
effect?
I would say we need to wait until the summer's over and then we'll know definitively by then.
Hmm.
US building starts, that is it's fallen a lot, hasn't it? It's back to its sort of roughly back to its few year pre-COVID level, the higher
Yeah, that's
point of
still
that.
not a bad number though,
No,
No, you know.
exactly. So, yeah.
Okay, so this chart shows multifamily starts top right. And so the starts is the blue line, permits is the grey line, and you'll see that most of the drop in overall starts is because of multifamily. Multifamily are big projects. Single family is maybe rolling over, but actually that is still a good number. And frankly, it's far too early to tell whether that's really rolling over. So the big drop in overall starts and permits is due to multifamily.
So US Empire State Manufacturing Index, I would say it's just in this continuing on this noisy decline at the moment.
Mm,
So actually, it's better than expectations, better than May, but it's still negative. And the US Philadelphia Fed Manufacturing Index, uh, significantly worse than May, significantly worse than expectations.
yeah. So we're not seeing a sustained rise in the manufacturing in the US.
No. Johnson Red Book retail sales 5.9% this week,
Mm.
5.8% last week. So that's looking good. Although it's
Yeah.
contradictory to the previous one we looked at.
Yeah.
The US NBA 30-year mortgage rate still at around about 7%, where it's been for a few months. And the NBA mortgage purchase index still at that sort of very low point.
Yeah. Very few people are taking out mortgages.
Yeah. Initial jobless claims, which we to 238, but again, nothing to worry about, I'd say, if you look at the shape of those bars.
Mm,
Continuing jobless claims. Again, it's at the top end of its range, but it hasn't broken out through that yet.
yeah.
But it's not indicating strong employment, is it?
No, I mean, so these charts from Parker Ross, and basically, if you ignore the seasonal adjustment and then just compare it to the pre-COVID average, so you're looking at top right here, then it is rising, but it's about 15% above the pre-COVID average, so not enormous.
And then the US Dallas Fed weekly economic GDP estimate is 2.7%.
Yeah, and actually, that's risen sharply over the last month. So the Dallas Fed thinks the US economy is strengthening.
Yeah. And the Atlanta Fed GDP now 3.1%, which is also a good reading.
Yeah. So that wobble we reported,
Yeah.
last month, that's all over.
And the New York Fed GDP now casts 1.9%, which is lower, but still roughly 2% and better than last week.
Yeah. I would say the New York Fed one is much more stable than the other two, which
Yeah.
does give you some, because the economy does not change that month, week to week.
No.
And this one appears, broader, more
Yeah.
reliable. But I mean, that's saying 1.9%. It's a perfectly good number, frankly.
Yeah. The Citigroup Economic Surprise Index, minus 24 this week. So a
Mm.
bit of bad news hovering around. And all of the surprise indices are showing the US economy. The surprises are basically to the downside. It's
Mm.
interesting. And Indeed continues to report declining job postings. And Indeed job posting, wage growth 3.1%.
Yeah,
I was
much lower
wondering,
than the UK, actually.
yeah, yeah. And on the low side for the data we've seen for the US, I think.
Yeah.
US Trueflation, 2.1%.
Yeah, that's a good number.
Yeah. And US implied gasoline demand is basically in line with previous years.
Yeah. So if gasoline demand is an indicator of economic activity,
There's no
US economy
problem.
looks absolutely fine.
Yeah. So read the summary, and the bottom line is that the US economy seems to be remaining strong, but maybe slowly weakening.
Yeah. And on to China. And actually, we've had quite a lot of Chinese data over the last couple of weeks. So this is inflation for May, which was disappointing. China falling back into deflation, down minus 0.1%, below expectations, down on April. Year on year, just 0.3%. That there's no evidence of excess demand in China, I think you could
No.
say. Producer price inflation Factory gate inflation, minus 1.4%, slightly better than expectations, but factory gate deflation. Industrial production, disappointing, 5.6% below expectations. Retail sales, though, better than expectations, up 3.7%. And when inflation is at 0.3% year on year, that's quite a big number. Fixed asset investment falling over. The unemployment rate, flat. House prices, even the official numbers, are now looking quite sick. May down 3.9% year on year, below expectations, down on April. Money supply, because there's falling loan growth, the growth in the money supply is stalling. 7% year on year in May, below expectations, down on April. And yuan loan growth, low, well below expectations. Year on year, 9.3%, in line with expectations, but continually declining. New vehicle sales massively missed expectations, up only 1.5% in May. And the balance of trade is incredibly strong, up on April, well ahead of expectations. So exports are supporting the Chinese economy. Very good numbers in May. Exports rose 7.6% year on year, well up on April, well ahead of expectations. Imports not great, only up 1.8%. And this is odd. If anyone knows what's going on, please can they get in touch? So these are bank withdrawals in China in April. Do Chinese consumers know something about the banking system that we should know?
And what do they do with it?
Well, sticking under the bed, probably. And this is the time it takes to clear the retail inventory in Chinese tier one cities. And it's growing. So more inventory, selling more slowly. And property prices falling. In summary, Chinese inflation was weak. Chinese economy seems to be doing okay, but it's got this structural weakness from the property sector, which is attempting to offset but through consumer spending and exports. Okay, on to one chart. Now, we talked previously about the losses from QE, and the FT had this chart, which neatly summarizes the effect of QE in terms of profits for the Bank of England and therefore the UK Treasury. And so, as we've discussed many times, QE simply time shifted interest payments. So in the early years, the Bank of England made a profit, and then now is making losses. And the net effect was simply to shift interest payments from then to now. And so in the coming years, we are here. We will have this continual drag on the fiscal balance from QE.
Yeah.
And the way the UK is dealing with that is very different from in the US. So in the UK, as we talked about previously, the Treasury is having to pay the Bank of England for its QE losses out of the budget, and that is exacerbating the fiscal deficit. Now, in the US, they're not doing that. What they did when they were making profits is they were remitting those to the Treasury, that's in blue, and then since they've started making losses, they've just created this negative deferred asset, which just keeps on getting bigger. And the US Treasury is not transferring money to the Fed to pay for that. This huge negative asset will be slowly written off against seigniorage profits from the Fed. So the US is being much less fiscally responsible than the UK is.
US can afford to be, can't it?
Well, yes, exactly. They are they have the world's reserve currency.
Yeah.
Okay, and on to France. Now, what's been happening in France? Well, in the June elections for the EU, the ruling Renaissance Party, that's President Macron's party, was soundly trounced by the National Rally, which is the renamed Front National far-right party, now led by Marine Le Pen. And you'll notice the socialists came a very close third. As a result, Macron has called a snap election for Parliament. That's the National Assembly. The first round will be on the 30th of June. And his gamble seemed to be that people will vote for the Front National in EU elections, which has a low turnout and people don't care very much, and he thinks is a protest vote. But when it comes down to voting for Parliament, that they will be sensible and vote for him. Now, the way the French electoral system works is that you have the National Assembly elections, which are these, and then you have separate presidential elections, and the presidential elections are in 2 years' time. And Macron is currently president. But so far, it ain't working. So these are the latest polls, and you'll see that the National Rally, so the right wing renamed Front National, is well ahead. And actually, the Socialist Alliance is a strong second, and Macron's party is, frankly, a distant third. Now, previously, we have talked about how actually the France is running possibly the worst fiscal deficit in the EU, in that it has a structural fiscal deficit, which is well in excess of all the EU debt sustainability rules. And a reminder of what those rules are. So renegotiated in 2023, the fiscal deficit has to be below 3% and the public debt has to be below 60%. Now, there are a lot of countries in excess of that. And the new agreement was that those countries would have to negotiate individually with the EU and agree a debt sustainability path, which would bring their debt on a declining path within 4 to 7 years. So they'd have some time to bring the deficit under control. And the problem for France is its deficit this year was 5.3%. And Moody's had already downgraded France's government debt because it did not think the debt was on the sustainable path. And that was before Macron called the election. Its debt to GDP ratio is 111%, and that's in 2023. It's forecast to rise to around 115% this year. So that's well in excess of the 60% limit. And it was given a formal warning by the European Commission for fiscal irregularities. Now, previously, because of the core partnership between France and Germany at the heart of the EU, the European Commission always gave France an easy ride, and they delayed fining it and always let it off. Now, if Marine Le Pen's party come in, and she has previously been arguing for Frexit and been very critical of the EU, then the European Commission will be inclined to be firmer with her in a way that they were firmer with Greece when it voted in a Eurosceptic party. Forecasts of the fiscal consolidation France would need to do to meet the EU rules are really quite frightening. So, France currently runs a structural primary deficit of minus 2.2% in 2024. Now, in order to meet the EU 3% fiscal rule, it needs to get the primary deficit to plus 0.8% by 2028. Reminder, it has got debt to GDP of 110% of GDP and interest rates are high. So it's paying a lot in interest. In order to get its fiscal deficit to 3%, it needs to run a primary surplus now.
Mm.
So that would mean that it needs to do a lot of fiscal consolidation over the coming years of around 4.5% over the next 4 years. So to cut the deficit by a cumulative 4.5%, that is big change. And one of the reasons Macron is unpopular is he's cut fiscal spending by 20 billion this year and is planning a further 20 billion in cuts next year. And that mild amount of cutting has led to his deep unpopularity. Now, both the right-wing Rally National and the left-wing Socialist Alliance have fought the election on manifestos of increasing the public fiscal deficit by around 1% per annum, which would bring them in direct conflict with Brussels and could lead to a Liz Truss style sell-off in the bond market.
Mm.
And both of them are Eurosceptic. So the moment Macron called the election, the premium on French government bonds shot up. And it's now stabilized at about 70 basis points. So watch this space. It seems very likely that the Rally National will win the most seats in Parliament in the election. But in order to get anything done, they need a majority in Parliament. So the question then is, can they form a ruling coalition? And can they get anything done? Now, thus far, whenever a European country has elected a Eurosceptic government, the Eurosceptic government has rapidly realized that they have limited room to maneuver and has towed the party line, the European Commission line. A very good example would be Maloney, who came in on a far-right Eurosceptic platform, but has actually been relatively sensible. Will France be different? We
Yeah.
just have to wait and see, but it's something to watch.
The problem we have is all of these indebted nations, though many of them have got themselves into a mess with the only way to win an election to be promised what can't actually fundamentally be delivered, or what makes the total situation worse. And they're all in the same boat.
Yeah.
The way
So,
it will be fixed is when it breaks, I suspect.
well, exactly. Everyone, during the pandemic, governments massively increased their fiscal deficits, and people have got used to that. And, you're talking earlier about what the Labour government's going to do. Well, the room for maneuver of a lot of parties is just very limited. They're going to have to bring the fiscal balance back under control, which means either getting interest rates down
Yeah.
or raising taxes. And if they raise taxes to get the fiscal balance improved, they will find that the interest rates come down naturally because fiscal responsibility is good for the bond market.
Yeah. Well, time will tell, won't it? But it's a difficult situation. And economically, Germany is not in a great place at the moment either. So
Yeah.
the two main stalwarts of the EU both have significant economic problems.
Yes, absolutely. The periphery is doing much better. But as we've talked about previously, the periphery has undergone 15 years of falling real wages to improve
Yeah.
their competitiveness.
Yeah. And
France, are they willing to do that?
and Italy's right wing move is turning the EU more right wing as well.
Yeah. And on to AI. Now, obviously, the Nvidia is now the most successful and largest company in the world. as we've talked about previously. And congratulations to everyone who has held onto the shares. But this segment is not really about Nvidia. It's about who is buying chips. And first of all, Amara's law, which states that new technology, everyone gets overexcited initially about its short-term impact. That leads to excessive expectations in the short run, which then, when they don't materialize, leads to the trough of disillusionment. But in the long term, people underestimate the long-term impact. And if you think about .com and the internet, this is exactly the pattern you saw.
Yeah.
And very similar is the Garner hype cycle. The shape is identical. So that brings us on to technology companies and who is buying the chips. Now, we know that the AI revolution has led to enormous investment in NVIDIA chips. So NVIDIA's sales growth has been absolutely off chart. When you look at previous technology revolutions, they have not seen sales growth anywhere near on this scale. And NVIDIA's revenues, this year they're forecast to double. Next year, they're forecast to go up by a further 50%, and then they're forecast to keep rising from there. These are astonishing numbers. So who's buying them? Well, the big tech companies have massively increased their capital expenditure this year. So what's that? The best part of up 80%.
60%, yeah.
Yeah, huge. And John Huber of Sabre Capital makes the following points. CapEx is rising, and that will hit earnings as depreciation expenses rise, and also it reduces free cash flow immediately. But what's the return on that investment going to be? We don't know. And although the growth in investment has risen a lot, it's uncertain that what the return on that capital will be. And unless it is at least as good as the return on capital they've currently got, you're going to see lower returns on capital in the future and possibly lower earnings growth. So watch this space. These are great companies, but they've got to earn a return on this investment. We don't know what that's going to be. Everyone's making a big punt. These companies are making a big punt that companies are going to be willing to pay a lot for AI services. If you think about Google and its ad revenues, is AI going to make any difference to its ad revenues? I don't think it will.
I'm quite skeptical, Keith. I think in the long term, AI clearly is obviously going to make a difference to a lot of things, but in the short term, I'm sure it's been overhyped, and I'm sure that it's going to be much harder to get functional AI systems that can genuinely properly interact with human beings than people think it's going to be. And I mean, clearly there are some areas where it's already helping software development. I think it's helping software development, but the getting it to that level of functionality where it can genuinely help with human interactions, I don't think we're anywhere near there yet. I may be proven wrong, but my sense is that a lot of this is people saying we have to be in this, and they have to be in it because everyone else is in it, and there'll probably be quite a lot of capital misallocation in this process.
I think that is an absolute given, Richard. Yeah, I completely agree. But the bottom line is the big tech companies have invested a lot and they need to earn a return on their investments in AI, or the return on capital will fall. So at some stage, they're investing a lot, but the market needs to see that they're making some money out of it.
So on to US non-farm payrolls. So this is an establishment count, which is suggesting that the change in establishments is indicating a reduction in the number of establishments, whereas the birth-death model, which is the model that non-farm payrolls uses for estimating the new employment coming in from new companies and jobs being lost from companies going bust. The birth-death model is suggesting that the number of establishments is remaining relatively constant, and the difference is big, as you can see.
Sorry. It's suggesting that the number of new employees from new businesses is remaining constant.
Yeah. So Bloomberg is estimating that the business closures are now subtracting from employment growth. In other words, the number of business closures is significantly in excess of what the birth-death model is suggesting.
Okay, so this is the model that shows the data used by Homebase, which covers employment in 100,000 US businesses and 2 million workers. And on the x-axis is the change in the Homebase index of payrolls. The y-axis is non-farm payrolls. And the two used to be highly correlated, i.e., changes in the Homebase index were very highly correlated with non-farm payrolls. But then when the Bureau of Labor Statistics has changed its birth and death model, you'll see that the two have deviated. And if you assume that the correlation between the home-based data and non-farm payrolls remains true, then actual payrolls need to be revised a lot lower. Bloomberg Economics believes that US job creation is only around 100,000 per month, rather than the 240,000 reported by non-farm payrolls over the last 3 months.
It's a big difference, Keith. So Bloomberg have started forecasting the false number and the true number. And their false number forecast was 222 versus the actual number of 272. Their true number estimate is 100,000. It's really interesting, isn't it? So they've come up with a way of predicting how much out the false number, in inverted commas, will be.
Yeah.
And what does this tell us about the US economy? That the employment is much less strong than we think.
Exactly. So I've given a choice between the labour force survey and the establishment survey, which produces non-farm payrolls. I would take the labour force survey. Now, the labour force survey is a survey, and therefore the numbers are volatile. But the establishment survey, which produces non-farm payrolls, relies on, most of the job creation is via this birth and death model. And the birth and death model just seems wrong.
Which is simply a factor. So, and the last bullet point here, that Q4 2023 data was released on the 5th of June, suggests the non-farm payrolls for the last 3 quarters of 2023 will be revised down by 750,000.
Yeah. And so, we've showed you charts earlier of like non-farm payrolls, the trend in it, and people extrapolating from the trend. Well, actually, I think when the non-farm payroll data is revised properly, you're going to see a very different shape of that graph.
Yeah. So if this is correct, then the lower job creation will completely change our view of the economy.
Okay. And last section, briefly, the European energy market. So this is coal consumption for power production and continues to fall. They're lower than its range over the last 10 years. That's good news. Gas consumption actually also right at the lower end of the range. So So larger zero carbon energy production is leading to lower coal consumption, lower gas consumption. All good news.
Yeah.
And in particular, in the UK, we've had like relentless rain. And in Europe, we've had relentless rain. And that means hydro production is above its 10-year average and the reservoirs are full. So that means that hydroelectricity should continue to operate above average for a while yet.
Yeah.
But that means LNG imports are low, have been falling. The good news is for the power market is as electricity prices have fallen, so consumption appears to have reverted towards its normal average for the year,
Yeah.
as has gas consumption. But European gas prices have risen despite the fact that gas consumption appears to be low compared to the 10-year average. And what this article was arguing was that that is all due to speculation. So this is investment positioning in Dutch TTF futures, which is European natural gas futures. And based on the size of the speculative positions, the author of this piece estimated that European gas prices were almost 10 euros above where they should be. So the rise in European gas prices we reported earlier is primarily due to speculation, and that appears to be unsustainable and is likely to unwind. Now, the other thing is LNG demand in Europe and Asia is running well below last year, just as the US is due to commission some big new liquefaction plants. And if you look at the added capacity, so the scale at the bottom here is quite idiosyncratic. You need to be quite careful looking at it. But Q4 2024, you're going to see an extra 10 million tons per annum of new capacity coming on. Q3, you're going to see about that 2.5. So you're going to see new capacity added all in 2024. But then in 2025, you've got loads of new capacity coming on. And also, in the next 18 months, 21.2 gigawatts of new nuclear will come on in the world, which is great news, actually.
Yeah.
So, bottom line is LNG demand seems low, just as there's going to be a lot of new capacity coming on.
Yeah.
And that's going to be bearish for natural gas prices, which is great for European consumers, and hopefully for inflation. Fingers crossed.
Fingers crossed. Yeah.
Yeah. Now, next week, we will do two discussions, one on migration, and also when I was in Dubrovnik, I was reading The Social Limits to Growth, which actually is quite interesting. We'll talk about that next week.
So just have a quick look at Inflation Watch. So UK CPI in May was 2%, which is down. Core CPI was 3.5% in May, which was down. And RPI was 3%, which was down. Our interest rate was unchanged at the Bank of England's recent meeting. In the US, CPI was 3.3% in May, which was down 3.4. Core CPI was 3.4% in May, which is down. And their interest rate is 5.25 to 5.5%, unchanged. Next meeting, I think, in August. Is that right, Keith?
Yeah, Bank of England's 1st of August. So
Yeah.
if we step back a bit, Richard,
Yeah.
the inflation definitely is coming down.
Yeah.
Now, skeptics will be saying services inflation is persistent. And the reason inflation has come down so much is that goods inflation has been negative. over the last
Yeah.
year. And if goods inflation now stops falling, service inflation will mean that headline inflation rises again. And I think that is likely to be true, but the extent of that is open to question. I don't think you're going to get a huge secondary surge. What I do think is that core UK CPI of 2%, Bank of England's forecasting is going to bounce to around 2.6% by the end of the year. I mean,
Yeah.
that seems entirely plausible. And onto other charts.
This is a correlation between sunspot activity and unemployment. So as sunspot activity increases, so does unemployment. Now, I remember once fooling a friend that there was a correlation between polar bear numbers and sunspot activity. And I mean, as far as I'm aware, there isn't. But it's very easy to come up with a spurious reason as to why that's the case. And I'm sure you could come up with a spurious reason as to why this correlation is so perfect.
Yeah.
But one suspects that this is a actually not a real correlation.
Yeah. It's sort of high quality correlation you get on this podcast, Richard.
Yeah, I say I think the chart of sunspot activity is very interesting. It's really clearly cyclical, isn't it?
It is, yeah.
And actually, it's quite low at the moment. And the second one is Canadian house prices, which actually quite like the chart of the Nvidia share price.
That just seems absolutely mad, the prices.
Yeah, it just doesn't it?
So
Well,
house affordability everywhere. I mean, the trouble with QE is that, how asset prices are downward sticky.
yeah,
So you've inflated house prices around the world, made
yeah.
them unaffordable for young people, and they're now, going to be slow coming down.
Oh no, I mean, it's just a real mess, isn't it? I mean, it is a real mess. And you could argue that QE was a concept invented by a bunch of well-off middle-class male economists. And
Mm.
in fact, their concept of what effect that was going to have on the real world was totally, totally wrong.
Yeah. Well, the thing is, it had a big distributional effect.
Yeah,
Asset owners, i.e., the middle classes and the upper classes, did incredibly well. Everyone else got stuffed.
yeah. And the younger generation now, the people in, let's say the working population from the age of 18 to 30, 35, being completely screwed by it.
Yeah, completely agree. Okay, and after that, some good news. Well, this is the Hawaiian goose. Now, when Captain Cook landed, that might be an unfortunate name, actually, given what happened next.
He cooked his
But
goose.
yeah, when Captain Cook landed, there are 25,000. By 1952, we'd eaten most of them, so there were 30 left. But actually, there's primarily the fall in numbers was because of introduced species. But now, after a captive breeding program, their numbers have increased 90-fold. So that's 90 times. And so from 30, they've now got a stable population of 2,800.
The
So
only
that's
problem is they've all got 3 legs and 2.5 wings, Keith.
unavailable in Sainsbury's. Right, right, equities, Richard.
Thanks, Keith. So the FTSE All World Equity Index up 0.8% on the week, up 10% year to date. So that's doing well.
So all these numbers over the past 2 weeks since we last,
Okay, yep.
reported.
And the FTSE All Share is up 6.5% year to date, slightly down over the last 2 weeks. And the Euro Stoxx 600 up 8.4% year to date and down 1% for the last couple of weeks. S&P 500 up 14.7% year to date, continuing its strong run from last year, up 2.2% the last 2 weeks. The Nasdaq up 18% year to date and up 3% in the last 2 weeks, mostly driven by Nvidia.
Yeah.
The Russell 2000 down year to date, 0.5%, only marginally down down 1.6% last 2 weeks.
Yeah. Now you see, this is really interesting.
Yeah.
Yeah. Nasdaq going through the roof, but
Yeah.
US small companies, the
Yeah.
broad mass of companies in the US not doing well.
No, having trouble. The Hang Seng up 6.1% for the year, but down 1.6% last couple of weeks. And the Topics 15% for the year, and down 1% for the last couple of weeks.
So basically, when you look at these charts, it seems like the world index, having had this extraordinary run since October last year,
Yeah,
appears to have hit at least a near-term peak for
yeah,
everything apart from US tech.
yeah. I think that's right. And where it goes from here, I mean, yeah, I think that's right. It depends what comes through with earnings, I guess, doesn't it,
Yeah.
really? So you have Bitcoin, which is up 52% year to date, but down 9% over the last 2 weeks. Pound against the dollar is still stuck within that sort of broad range of 127, 128, and 122. So there is 126.69. And the euro against the dollar actually stood in the same place because the dollar index is also in that range, I would say. So down 3% year to date, down last week because of
Yeah.
the interest rate reduction. So there's a dollar index, which is at 105.5, up 4% year to date. So the VIX is still really, really low, but it's bounced up a little bit. So the year to date change is actually 7%, and it bounced up in the last 2 weeks, but it's still very, very low.
Yeah. Still very low.
And US household stock asset allocation is at an all-time high as a percentage of total financial assets, 35%. And CTAs are also very exposed to equities, not the longest, the most exposed they've ever been, but 70%, pretty high.
Yeah. So everyone's long equities, basically.
Yeah. And yeah, over time, there's quite a strong negative correlation between the net asset allocation to equities and future returns, which is the higher the allocation now, the lower the future return.
Yeah. Now, we've previously done, various segments on the only stock predictor you ever need, which is this. So basically, the net asset allocation to equities. Have a dig through, if you're interested, have a dig through previous episodes, do a
Yeah.
search, and you'll find it.
So the Nasdaq is the most overbought it's been since 2018. At some point, that will reverse, but who knows when.
Yeah.
And investor sentiment is super bullish, which is a sort of contrarian indicator, but it could remain super bullish for a long, long time.
Yep.
And the Mag 7 since the start of 2020 are up threefold. The rest of the S&P is up 43%.
Yeah.
So huge digression there. And the large caps are massively outperforming the small caps. And that trend is looking at back to 2000. And the
Yeah.
question is, are we reaching a tipping point? Question.
Well, it's a very similar
Yeah,
to .com, isn't it?
yeah. And whilst tech stocks are marching higher, breadth, which is how many companies are participating in an upward trajectory, is deteriorating. So fewer companies are going up. The equal weighted S&P has already peaked. So it's just a different way of measuring the S&P. The S&P is 25% higher than when the Fed started to raise rates in March 2022, which of course is rather counterintuitive.
Yeah, absolutely.
And buying the dip has been an extremely effective strategy during a year of inflation targeting. So should we all go out and buy the dip, Keith?
Well, this is really interesting. So, there seems to have been this regime change in, 1990.
Yeah,
If the S&P 500 falls and you buy it, you get good returns the
yeah,
next day.
yeah.
It's extraordinary.
So the Husband Strategic Advisors valuation model says that equities are very close to their most expensive in history, and the previous high was 1928.
Yeah, thanks to Wayne J for sending that.
It's quite interesting, isn't it? Of course, it doesn't mean they can't go higher, but future returns are likely to be poor,
Yeah.
starting at some point.
And thank you to Spider786 for pointing that out.
Yeah. Now, I mean, the question here is, are we going to see significantly higher productivity growth? And if
Yeah.
we are, then that leads to strongly rising earnings, which justifies then the levels of the valuations in the stock market.
And this is from Simon, who has played Nvidia incredibly well and has been absolutely right so far, whereas
Yeah.
I've been relentlessly skeptical and wrong.
Yeah. Likewise, Keith.
Commodities. So, quick summary: energy showed broad strength. Oil, in particular, has bounced from its previous weakness. Industrial metals, though, having had a very strong run in the period to May, have come off their peaks. In precious metals have followed. So, looking at oil, this is Brent up 7.4% over the last 2 weeks, unwinding all that weakness from the OPEC meeting. And actually, that's towards the upper end of its range over the last 8 months. WTI, very similar pattern, strong bounce. So moving on to data specific to the oil market. The latest data continues to show inventory builds in the US.
Mm.
So over the last 2 weeks, we've had a further build of 12 million barrels, including the SPR. So the US market remains oversupplied, and that would imply that the rise in the oil price does not look sustainable. Crude oil production in the US also ticked up 100,000 barrels a day over the last 2 weeks, but still down on since the start of the year. The Baker Hughes rig count continues to fall, down 12 on the year, and so fewer rigs are supporting more oil production. US shale drillers are getting more and more productive. Now, these are European natural gas futures, and as we discussed earlier, that rise does not appear sustainable. It's been, according to the piece we showed you earlier, that's due to speculation rather than fundamentals. UK, the same. US natural gas futures, having bounced very strongly from their lows, appear to have hit a near-term peak, up 9.2% year to date. Coal fading. This is coal consumption globally, and you can see at the bottom here, consumption in the West has been falling very sharply, but it has been more than offset by rising consumption in the East, and China continues to build coal-fired power stations. Now, if you look, since 1990, when we all started getting worried about global warming, coal consumption is up, 70%?
Mm.
Uranium drifting off, I think you'd say. On to industrial metals, Richard.
So, aluminium up 5.4% for the year. Cobalt is down 7% for the year. Copper up 17% for the year. Chromium down 3% on the year. Iron ore down 25% on the year.
Yeah, and that bounce in May is totally unwound. I mean, this is
Yeah,
what you'd expect to see, given that we know the Chinese construction market, which is a huge consumer of steel, is doing badly.
yeah. Lithium actually down 7% on the week, only down 2% on the year. Neodymium down 20% on the year. Nickel up 5.5% on the year, but down 6% last week.
Yeah, but
That's pretty
previously,
good.
when we were covering this extraordinary rise in the nickel price, I mean, I
Yeah,
was mystified because we know Indonesia is producing loads of nickel.
yeah,
So I couldn't really understand why the nickel price was rising on the back of all these surpluses.
yeah,
Well, it was unsustainable.
yeah, yeah, completely. There's tin up 26% on the year, and ferrovanadium uh, up actually on the year by 2%, unchanged over the last couple of weeks.
Yeah. I'm seriously considering actually getting rid of vanadium.
Yes.
If you want me to retain vanadium, please write in. But the bottom line is, I don't think vanadium redox batteries are getting traction. I think everything's going to lithium.
Yeah. I won't be writing in, Keith. Zinc up 7% on the year, and precious metals. So gold's up 15% on the year. It's spent the last month or two consolidating around well, between 2,300 and a little bit over 2,400. And there's silver. So silver's up 26% for the year. It too is consolidating but over quite a bigger range.
Mm.
Um, and again, I mean, I think silver is driven by industrial demand, and the question is industrial demand going to push the price of silver higher? It's mostly photovoltaic cells. I
Yeah.
suspect it will.
So gold could well, if France votes in the national rally,
Yeah,
you could see gold having a good run
yeah,
because we've talked about previously how the Eurozone long term just seems unsustainable. They've always patched it together. Well, one of the core partners, you know,
yeah.
becoming voting in a US skeptic government and getting into conflict over the fiscal rules, that brings into question the whole project.
It certainly destabilizes it significantly, doesn't it? Will
Yeah.
do. And there's platinum pretty much unchanged on the year, actually, although it had a bit of a spike in
Mm.
early May. Well, that was really long with the spike in gold, wasn't it? I think a lot of them they just followed up.
Yeah.
Rhodium up a little, up 6% on the year, and palladium down 25% on the year. This presumably is to do with industrial demand, catalytic converters.
Yeah. Yeah. You'd expect though, because we know that EV sales are growing, but much more slowly than previously,
Yeah,
meaning continued demand for internal combustion engines and actually continued demand for the PGMs. Now, we know that during the COVID pandemic, the there was a build-up in inventory which needs to be got through. But once
mm,
that inventory has been used up, you'd
mm.
expect to see PGM prices rising again.
Yeah, that's true.
Thank you, Richard. On to rates. So this is the UK yield curve. Very disappointing for me in that UK inflation came in soft and headline inflation is back down to 2%. But the yield curve has barely shifted. So long bonds in particular, not done great. US yield curve has done better than the UK, surprisingly, given that the UK um, inflation is back down to 2% and US inflation is not. So this is the UK 2 year going down to 4.2% average over the next couple of years. So the market is not pricing in big cuts to UK interest rates. 10 year at 4.06, 30 year 4.6. So big yield premium for holding duration in the UK. And hopefully, once the Bank of England starts to cut rates, then the whole yield curve should shift down, he says, fingers crossed. This is the US 10 year, actually come down quite sharply over the last month and a half. That's about a 50 basis point fall. Right. Best part of this is German. The sharp drop over the last month. French net risen. So actually, we talked earlier about the premium in France. Well, the premium actually largely results from people running to German bunds rather than them necessarily fleeing French
Yeah.
government bonds.
Mm.
And Italian, Italy doing well, actually. Greece going nowhere. So concluding comments. Well, a lot of new macro data this week. Inflation is coming down in the UK and the US, but services inflation in both countries remains high, and that means interest rates are not coming down. The Bank of England was surprisingly dovish, actually, I thought, and left open the possibility of cutting first in August. The US labor market does appear to be slowing. And we've talked about this. The non-farm payrolls in May were strong, but I just don't think they're right. Richard, what have you been up to?
Well, Keith, you won't find this surprising, but not very much. I've so I with the pullback in gold and silver, my portfolio is a few percentage points down, but it's done well so far this year.
Very good.
And I what I would like to do, and I think I've talked about this before, I would like to, um, in due course, move a little bit more out of precious metals and into probably copper. But I'm firmly in the commodity camp, and I'm not really proposing to move out of commodities anytime
Mm,
fast. I think what your comments on natural gas are really interesting because there are some commentators who are saying natural gas is a fantastic investment. It's but what basically we're saying here is that supply is coming on, demand isn't going to increase that much, price is going to drop.
yeah.
So, and I know there's huge reservoirs in the US as well. So that's quite an interesting sort of counterpoint to that. So I'm going to steer clear of natural gas. And I do think that there's potential for the price of oil to rise. And I think I mentioned that I did buy a couple of oil ETFs, an oil services ETF and an oil production E&P ETF a few weeks
Right.
ago. But basically, that's it. How about you?
Well, my terrible year continues. So, I put all this intellectual effort into getting it entirely wrong. So up 0.1% over the last couple of weeks. It's down 8% on the year. But I mean, the thing is, it's a long game. And I was thinking about this. I've got another 30 years to go. And, you just have to learn your lessons when you get it wrong. And actually, I was talking earlier about Simon on the Discord and how he doesn't attempt to value the market. The market does that and he just follows it. And actually,
Yeah,
in this case, he's been absolutely right. And I have been trying to time the economic cycle and have
yeah,
been wrong.
yeah,
And now the thing is, this is an extraordinary cycle. And things like the future, the things such as the yield curve and the leading economic indicators were all forecasting recession, and that just hasn't occurred. So, I mean, I put this trade on for good reason, and it turned out to be just wrong. Now,
yeah,
going forwards, I am expecting that the very high valuations in the US just can't be sustained. And at
yeah,
some stage, there will be a big buying opportunity that I then need to react to.
yeah.
But I'm also concerned about what the Labour government are going to do to CGT. Because if they normalise CGT and
Yeah,
income tax,
yeah,
then what we all do as private investors, you need to basically change your entire strategy. You just can never sell. You
yeah,
need to then make a single asset. You can either buy government bonds like index linked gilts and get capital gains tax free real returns for the rest of your life, or you just have to buy a high dividend yield ETF and just never
and
sell
hold
it.
it. Yeah,
Yeah. And
yeah,
actually, if they do that, then the game for private investors completely changes. You can only mess around in your SIP, in your or your ISA. In
Yeah.
your main portfolio, you've just got to, stick it all in our dividend yield ETF and forget about it.
Yeah, I think you're completely right, Keith. It will be very painful indeed.
Yeah, because I mean, if you're paying out 45% of any gain,
Yeah,
it's pointless playing the game. You don't
yeah,
play the game.
yeah, completely.
So, lots of macro data to digest this week. Next week, we'll have more of a discussion actually, because I've got a few things we want to talk about, like migration and the social limits to growth, and finally, the gold standard. Um, I hope you're all enjoying the summer and doing better in the world than I am. But in the meantime, thank you for watching. Please, can you press like and subscribe to the channel? And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.